All right, Chapter 9, Fixed Assets. So fixed assets are purchases of tangible, long-term assets. Equipment, buildings, machinery, delivery trucks, airplanes, tanker ships. They all are physical in nature. You can touch them. They have some sort of physical substance. And they're owned and they're used in its normal operations. A company may buy a piece of land, or it may buy a land with a building on it that they're eventually going to tear the building down and then build a factory at that site. That's not a fixed asset. Until such time that they do tear the building down, build the factory, and start using that in their normal operations, it's an investment. All right? So it's only those tangible assets, long-term, going to be used for more than a year, that are used in the normal course of business operations. They make up a substantial part of the total fixed assets. You can see Exxon, 68% of their total assets are fixed assets. 22% for Ford, 62% for Kroger, which is a grocery chain up on the East Coast primarily. All right? So these are large type purchases. So the cost that's been incurred can either be a fixed asset, an investment, or an expense. All right? So if you're going to use it for less than a year, office supplies, you buy a temporary piece of equipment that you have no intention of using for more than 2 or 3 months, then that is an expense. If you're going to use it for longer than a year in your normal operations, that's a fixed asset. If it's a purchase for future operations, somewhere down the road, a piece of raw land or a building or something like that, then it's an investment until such time that you convert it and start using it in your normal operations. All right? All right, so the two decision processes is it purchased for a long term, longer than a year? If yes, is it going to be used in the normal operations? If that is a yes, then it's a fixed asset. So here it is. If it's not going to be long term, then it's an expense. If it's yes, is it going to be used in normal operations? If that is yes, then it's a fixed asset. If it's not going to be used in normal operations, it's an investment. So the cost that is capitalized on the balance sheet under these various categories, buildings, equipment, factory machinery, delivery trucks, computers, and the like, it's everything that you're going to incur in order to place the asset into service. All right? So here's a listing of various types of expenses. So a building, for instance, you're going to capitalize the architect fees, the engineering fees, the fees from the HVAC people, the heating and air conditioning, and the like. Interest on money borrowed to finance the construction, reconditioning, modifying it, use permits from agencies and the like. Machinery and equipment to freight in. So if it's FOB shipping point, you're buying a piece of equipment, the freight to get it to your place of business. You may have to rent a crane, so to get it off the back of the truck. That is capitalized. You may have to rent a motorized dolly. You place the equipment on the dolly to drive it into your factory. You may have to rent another crane inside the factory to pick it up off the dolly and set it in place. Building the safety equipment. There may be some fencing or some railings that you put up. All of that is capitalized and included in the price of the equipment. Okay? Unnecessary costs that do not increase the asset's usefulness, mistakes in installation, uninsured thefts, damage during packing and installation, all of those are expensed as they are incurred. They're not capitalized. So costs that only benefit a single period are revenue expenditures, and these, like maintenance and repairs, these are expensed. So if you tune up a delivery truck, that's an expense. If you put a new set of tires on a vehicle, that's an expense. The ordinary repair and maintenance associated with keeping the equipment in good working order, those are all expenses. If, however, you go and put a new engine in a delivery truck that extends its life, you were originally going to drive it for 5 years, now you're going to drive it for 7 years, that's a capital expenditure. If you put a new roof on a building that extends its life, that's a capital expenditure. Putting in a new elevator system, a new heating and air conditioning system, all of those are high dollar, extend the life of the asset, and are capital expenditures. So here's an example: repair and maintenance. You tune up a delivery truck, put new spark plugs in it, tune it up, change the oil, $300, that's repair and maintenance. If you put a new hydraulic lift on the back of a delivery truck in order to allow for easier unloading of the heavy cargo, that cost you $5,500. That is a capital expenditure, and you readjust your depreciation method in order to reflect that increased cost associated with that capital expenditure. So depreciation is the systematic expensing of a capital item, of a long-term fixed asset. All right? So depreciation is only done for tangible, long-term fixed assets. Later in the chapter, we'll talk about natural resources such as timber or coal or gold or oil. The expensing of that is called depletion. And then an intangible asset like a copyright, a patent, things like that, that is amortization. So depending upon the type of asset is the type of expense. All right? Land is considered an unlimited life. Land does not get depreciated. Fixed assets that are not land are depreciated. So the adjusting entry is a debit to depreciation expense, and it's normally depreciation expense, either dash or comma, and then the type: equipment, depreciation expense, computers, depreciation expense, office furniture, stuff like that. And then the credit is this contra asset account that we introduced in Chapter 2. The negative asset account normally has a credit balance, accumulated depreciation for the various classes of assets. Right? So this allows the original cost to remain unchanged in the fixed asset account, so that the readers of the financial statement can see not only how much you've depreciated, giving them an idea of how long you've been using your fixed asset, but how much they originally cost. All right? And this can be very important for certainly various types of industries. All right, so depreciation is the physical or functional factors. Things wear out. You have to replace them. You have to get a new delivery truck because the wear and tear of driving it every day. You get new manufacturing equipment not only because it wears out, but because it becomes obsolete. There are newer, more efficient manufacturing equipment being invented every year. So oftentimes you replace a perfectly functioning fixed asset because a newer one will save you money in raw materials, or it will do the job much, much faster. All right? So it depends on, there are two factors here. both wear and tear and obsolescence. You need three items in order to calculate depreciation. You need to know what the initial cost is, and that is the total cost that I talked about already. The total cost associated with placing the asset into service. You need to know how long you're going to use this asset. And there's some general guidelines. Normally, buildings are 20 to 35 years. Computer equipment is pretty standard, 3 years. Manufacturing equipment can be anywhere from 5 to 10. A delivery truck or a delivery vehicle could be 5 years. So there's some general guidelines, but it's entirely up to the company. What is management's intent? When they bought this equipment, how long were they going to use it? All right, so that's the useful life. And then we need to know how much is the residual value. The residual value is what are we going to get for this asset when we're done using it? Is it just scrap? Do we just sell it to the iron recycle place for metal for $100? Or will it have value? And so you need up front an estimate as to how much you're going to be able to get for this vehicle when it's finished. All right? Like this one says, estimates for useful lives are available from various trade associations. There's some general guidelines out there, but most of the time you make your own decisions. You're not obligated to do that. It's whatever management's intent is. So here's the residual value. The residual value is the estimate at the time you buy it that you're going to be able to get for this asset when it is finished. What is its trade-in value? So the difference between that original cost and minus the residual value is the depreciable base. Your textbook calls it the depreciable cost. So how much of the original cost are we going to then systematically expense over the life of the asset? All right, so we have the initial cost minus the residual value is the depreciable base, and then we're going to spread that, in this case, over 5 years in a periodic depreciation expense. Overwhelmingly, there's 3 types of depreciation methods that we're going to talk about in this chapter. Straight line depreciation, units of production, or units of output is what your textbook calls it, and declining balance. And we'll use what is known as a double declining balance. So there's 3 methods. Straight line, as you can see from this pie chart, overwhelmingly. This is from Accounting Trends and Techniques from the American Institute of Certified Public Accountants. Overwhelmingly, straight line is used in the United States. Easily 95% of all companies straight line depreciate the fixed assets. Then you can see maybe 1.5% is units of production, another 1.5% declining balance, and then other is there's some other types out there that are very unusual. All right? So how do you calculate straight line? Straight line is the same depreciation expense for the first year through the life of the asset. You take the initial cost, subtract the residual value to come up with a depreciable base. In this case, we have an initial cost of $24,000. At the end of 5 years, we're going to get $2,000 for this piece of equipment. That's a depreciable base of $22,000. Divided by 5 years, $4,400 per year, each year for each of the 5 years. It's the same. Does everyone understand that? That one's the easy one. Okay? If it's a partial year, in this case, they bought it and placed it into service on October the 1st. So that's the first of the fourth quarter. So there's 3 months, October, November, and December, left in the year. You're going to take that same calculation of $4,400, now divide it by 12, and then multiply it by 3. Take 1 quarter, or 1,100. So this is a partial year using the closest month. You can use the closest month, you can use the closest half year, you can use the closest quarter. Once again, it's called a convention. What is the decision of management on when they set up these policies? So most companies use the closest month. So if you buy it between the 1st and the 15th of the month, you take a whole month. If you buy it from the 16th to the 31st, you don't take a month in that particular, and then you take the following month. Okay? Straight line percentage is simply 100% divided by the expected useful life. So rather than dividing it by 5, you can multiply it by 20%. If it's an 8-year property, it's 12.5%. If it's a 25-year property, it's 4%. We're going to need to know those percentages here in a second when we get to the double declining balance methodology. But it's just another way of calculating the annual depreciation. Okay, units of output. This is the same type calculation, only rather than using the number of years that we're going to use the asset, we use some sort of units over the useful life. This is especially common in fleet vehicles. You may buy a vehicle, whether you're a rental car or a taxi company. You buy a vehicle and your policy is you're going to drive it for 100,000 miles. Well, you take that same depreciable cost, the initial cost minus the residual value, and now you divide it by the 100,000 miles to come up with the depreciation expense per mile. And then you go out there at the end of the year and you read how many miles was it actually driven. And you multiply that times the rate that you calculated, and you do that. This is also very common, like generators. They have something on it called a Hobbs meter. A lot of manufacturing equipment also has this. It's a meter that runs on a per hour basis. So the minute you cut the generator on, this little meter runs. So you estimate you're going to run this thing for 250,000 hours over its life. And so you go out there and you read how many hours you actually ran it during the period of time and depreciate it as such. So it's the same sort of thing. The numerator is the same, cost minus residual value or the depreciable base. Only now you're going to divide it by the total units of output. So here's a same piece of equipment, $24,000 with a residual value of $2,000. Only now we're going to operate it, rather than 5 years, 10,000 hours. So the depreciation per hour is $2.20. The same 22,000 depreciable cost divided by the 10,000 hours. And then you go out. In the first year, it was run for 2,100 hours. Multiply it by the $2.20 per hour, and your first year's depreciation is $4,620. Right? You do that same thing for every year for the 5 years. So this is probably the most complex one, but it's not difficult. And that's double declining balance. Double declining balance is an accelerated method. It front loads in the early years the depreciation expense. So the depreciation expense will be very high in the early years, and then it will lower. There's 2 fundamental theories behind using this method. The first is that when the equipment is brand new, it's most efficient. It's going to generate you the highest amount of revenue. And always we're trying to match the expense with the revenue generated. As machinery ages, it begins to break down. It's no longer as efficient. It's not leading edge technology. And the revenue drops off. The second theory behind using a method such as this is that as the equipment ages, the cost of maintaining it, repair and maintenance, goes up. So as the cost of repair and maintenance goes up, the cost of depreciation goes down, and so the total cost of depreciation plus repair and maintenance is kind of flat over the life. So those are the two reasons people do a double declining balance. On this one, you need to start with the straight line percentage. So we talked about that earlier. It's just 100% divided by the number of years. So 5-year property, 20%. 10-year property, 10%. All right? You're going to then double it, hence the term double declining balance. So for a 5-year property, 20% is the straight line rate. You're going to use 40%. And you're going to then multiply that by the book value of the asset. Book value, if you recall from chapters 5, is the original cost minus the accumulated depreciation. So when it's brand new, the first year of operation, the book value is the initial cost. So this one is different than the straight line in the units of production. Units of production and straight line use the depreciable cost as the numerator. This one uses the book value. All right? So, same scenario, 5-year asset, $24,000 initial cost, residual value of $2,000. So the straight line percentage is 20%. That's 100% divided by 5. Double that is 40%. 40% times 24,000, not the 22,000, is $9,600. What's the book value then for the second year? Take the 24,000, subtract the 9,600, you get 14,400. 14,400 times 40% is 5,760. Now you have 8,640 as the book value. Multiply that by 40%. Year 3 is 3,456. Now you have 5,184. In each case, all we're doing is we're taking the book value at the beginning of the year, subtracting the depreciation. That gives you the book value at the end of the year. 40% of the 5,184 is 2,073.60. Now in year 5, here's where the residual value comes into play. We have $3,110.40. 40% of that is going to be somewhere around $1,250. Too much, because it's going to drive the book value below the residual value. All right? So after the first year, you take the cost minus the accumulated depreciation and multiply that by the 40%. In the final year, you're going to take whatever it takes to get it down to the residual value. So we have a book value of 3,110. We're going to depreciate only 1,110 and 40 cents to bring it down to the $2,000. All right? Does that make sense? We'll be doing lots and lots of examples on Wednesday. So remember, the third midterm, which is the last of the 3 midterms, is 1 week from Wednesday. So not this week, but next week. on Wednesday. All right, prorated depreciation, it's the same as what we did. Calculate what the annual depreciation is, in this case $9,600, and then divide that by 12, multiply it by 3 if we put the equipment into place on October 1. And then the second year depreciation is you take the book value and multiply it out just like you normal. So the book value, because you only took $2,400, the book value is going to be $21,600. Multiply that by 40%, and you get $8,640. So this is an accelerated method. More revenues are generated in the early years, like I said, and so it becomes a good matching of depreciation expense with the revenues generated. So here's the various summary of it. Straight line method, we use number of years. It's cost less residual value divided by the useful years. It's a constant depreciation over the life of the asset. Same year in and year out. Units of production is also cost less the residual value. Only now it's times the units of output, whether they're hours or miles or units produced from a press or an assembly machine. And then lastly, double declining is twice the straight line rate. Straight line rate is always 100% divided by the useful life. All right? So those are the three basic methods that we'll be talking about in this chapter, and that's what will make up one of the 4 questions on the last and final midterm. So 1 week from today, we'll be doing a review on that. All right, so under straight line method, we took 4,400 each year. Under units of production, it depends on how many hours the machine ran. So 4,620 the first year, but only 3,300 the second year because it only ran for 1,500 hours. Double declining starts with 9,000 in the first year, drops to 57, and then drops all the way down to $1,000 by the final year. In each case, it is always going to have a total depreciation expense equal to the depreciable base of 2,200, the initial cost minus the residual value. So what do we do when we finally get rid of these fixed assets? Well, if you're just going to scrap it, you're not going to get anything for it, all you do is debit the accumulated depreciation, zeroing out that contra asset account, and then write off the equipment. All right? So if it's fully depreciated and you're just going to throw it away, then it's a debit to accumulated depreciation for equipment and a credit to equipment. If it hasn't been fully depreciated, you're first going to calculate the depreciation, just like if you bought it in mid-year. If you dispose of it in mid-year, you're going to depreciate it first. So if this has a straight line rate of 10%, it was a 10-year asset, you're going to get rid of it at the end of March, then the depreciation expense is going to be $150. All right, the equipment originally cost $6,000, 10-year life with no residual value. So that's $600 per year. 1/4 of that is $150. And then you're going to write off the equipment. So you'll take the credit to the equipment for the $6,000. You now, with this $150 added to it, you now have $4,800, and you have a loss on disposal of equipment of $1,200. What if you sell the asset? Well, you always compare the selling price to the book value. If you sell it for more than its book value, you have a gain. If you sell it for less than its book value, you have a loss. If you sell it for exactly its book value, you don't have anything. No gain, no loss. So once again, 10-year asset originally cost $10,000 with no residual value. So you're taking $1,000 a year. In this case, you're going to get rid of it on October the 12th. So you're going to first depreciate it. It's normally $1,000 a year, but now you're only doing it for 9/12, or 3/4 of the year. So that's $750. So now the book value, and this was the 8th year, so you've depreciated it for 7 years. So that's $7,000 at $1,000 a year, plus the $750 for this year is a total of $7,750. That's a book value of $2,250. If you sell it for $2,250, no gain, no loss. Debit to cash, debit the accumulated depreciation, credit the equipment. If you sell it for $1,000, now you have a loss, because the book value is $2,250. You're selling it for only $1,000. Your loss is $1,250. If you sell it for $2,800, you have a gain. Book value of $2,250. Let's subtract that from the cash that you're receiving of $2,800. You have a gain of $5,500. So calculating gain and loss is the second of the 4 questions on the 3rd midterm. So if it's higher than book value, that's good news, it's a gain. If it's lower than book value, that's bad news, it's a loss. All right, I told you already, natural resources are depleted rather than depreciated. So this includes timber, natural minerals, ore, whether it's gypsum or uranium or coal or whatever it is, oil is all depleted. So it's the cost of the resource divided by the estimated total units of the resource, the reserves in the oil and gas industry. Okay? That will give you a depletion rate, and then as you pump this oil out of the ground, you multiply that times the depletion rate, and that gives you the depletion expense for the year. So assume that you buy a mineral deposit for $400,000. There's 1,000,000 tons expected to be extracted from that mine. Well, 400,000 divided by 1,000,000 tons is 40 cents per ton. If during the first year of operating this mine, you extract 90,000 tons, that's a depletion expense of $36,000. The 40 cents times the 90,000 tons. So that's depletion. And the debit is the depletion expense, and the credit is to accumulated depletion. Another contra asset account. And then lastly, intangible assets. Intangible assets do not have a physical substance. They are just value, but they're legal terms. They're rights to a legal item, and they vary. Patents are the most common. You go out and you buy a patent, and it costs you, $1 million. You're going to be using that over once again, its useful life. Because patents have a legal life of 20 years from the date that they're filed. Well, you may not use that patent for 20 years. Especially in the technology industry, you may only use it for 3 or 4 years, because then it'll be obsolete. So it's always the useful life. So patents, like I said, in effect for 20 years, but it depends on how long you intend on using it. whatever the initial cost is. And then you debit the amortization expense and you credit the patent account. There's no accumulated amortization accounts. You credit the actual account for purposes of this. There's no contrast in intangibles. So here's the example. Amortization expense on patent, that you're going to use it for 5 years. Even though the patent won't expire for 14 years, you're going to use it only for 5. So that's the key. It's useful life. And think about it matching once again. It makes no sense to spread this $100,000 over 14 years that you have a legal right to, because in year 6, 7, 8, 9, and on, you're not going to be generating any revenue. You're going to be done with it. So you're only going to amortize it $20,000 per year over the 5-year useful life. If you're developing an internal patent is not capitalized. So your internal patents in the United States, at least, internal patents are research and development, and these costs are expensed as incurred. There's no capitalization. Copyrights are issued by the federal government, and they're good for 70 years beyond the author's death. Which is why you can go out on the internet right now and you can read Shakespeare and Edgar Allan Poe and people like that for free. Mark Twain. But you can't read Hemingway. You can't download a Hemingway book for free because he hasn't been dead 70 years yet. All right, he died in the early 60s. So it's the extended for 70 years beyond the author's death. But once again, if you buy a copyright, you're going to amortize it over its useful life. If you buy a book from an author and you're going to publish it for 5 years, let's say, and at that point you're no longer going to sell it anymore, then you can amortize the cost of that copyright over the 5 years that you intend on selling it. Trademarks are really indefinite. So the Nike swoosh, I don't know, what do they call the Adidas, the little stripes there, the 3 stripes on Adidas. All of those are indefinite. But you have to renew them. You have to relicense them every 10 years. All right? So the McDonald's Golden Arches, Coca-Cola has what is known as the Coca-Cola Wave. All of these trademarks have to be renewed every 10 years. But you can do so forever. For as long as you want to register it, you can continue to do so. And the cost of registering it is capitalized. You don't expense it. You put it on the balance sheet. Trademarks indefinite.